Welcome back to my channel. Today, we're diving deep into the world of finance to explore the top investing strategies that can help you build and grow your wealth. If you're ready to take your financial future into your own hands, you're in the right place. Remember, this is not financial advice. Let's jump right in. 1. Dollar cost averaging. So, what exactly is dollar cost averaging? It's a strategy where you invest a fixed amount of money at regular intervals, regardless of the current market conditions. This means you buy more shares when prices are low and fewer when prices are high. The goal? Smoothing out the impact of market volatility over time. Let's break it down visually. Imagine you invest $500 every month in a particular stock. If the stock price is high, you'll buy fewer shares, and if it's low, you'll buy more shares. Over time, this strategy results in a lower average cost per share, providing a cushion against market fluctuations. Now, why is dollar cost averaging so powerful? Well, firstly, it removes the need to time the market. Instead of worrying about the best entry point, you consistently invest, taking advantage of market highs and lows without the stress of making perfect predictions. Secondly, it instills discipline. By sticking to a regular investment schedule, you cultivate a disciplined approach to building your portfolio. This consistency can be a game changer in achieving your long-term financial goals. And thirdly, dollar cost averaging reduces the impact of emotional decision-making. Fear and greed can lead investors to make impulsive decisions. This strategy helps mitigate those emotions by focusing on a long-term, systematic approach. Before we go to our second strategy, remember to like the video and subscribe to the channel. 2. Long-term investing. Long-term investing is all about patience. It involves carefully selecting solid, well-researched investments and holding onto them for an extended period. As Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. The key benefit of long-term investing lies in giving your investments the time they need to grow and compound. By avoiding the temptation to constantly buy and sell based on short-term market fluctuations, you allow your portfolio to weather the storms and benefit from the overall upward trajectory of the market. Look at legendary investors like Warren Buffett or Peter Lynch. They didn't achieve their success overnight. It was the result of decades of patient, long-term investing. Their portfolios have weathered market downturns and economic crises, emerging stronger on the other side. To implement long-term investing, start by setting clear financial goals. Identify investments that align with your objectives, whether it's retirement, education, or wealth accumulation. Conduct thorough research, diversify your portfolio, and resist the urge to react to short-term market noise. 3. Diversification. Diversification is a strategy that involves spreading your investments across different asset classes, industries, and geographic regions. The goal is to reduce risk by avoiding overexposure to a single investment, sector, or market. Imagine your investment portfolio as a garden. Instead of planting all your flowers in one spot, you scatter them throughout the garden. If a storm hits one area, the rest of your garden remains unaffected. Diversification works similarly, helping protect your overall portfolio from the impact of a single economic event or market downturn. The primary benefit of diversification is risk reduction. By holding a variety of assets, the poor performance of one investment is balanced by the potential success of others. This can lead to a more stable and consistent long-term return on your investment. Look at the financial crisis of 2008. Investors heavily concentrated in real estate suffered significant losses. However, those with diversified portfolios that included various asset classes like stocks, bonds, and commodities fared better during the economic downturn. To diversify your portfolio, assess your risk tolerance, financial goals, and time horizon. Allocate your investments across different asset classes, such as stocks, bonds, real estate, and commodities. Within each asset class, further diversify by investing in various industries and geographic regions. 4. Dividend investing. Dividend investing revolves around selecting stocks that pay regular dividends to their shareholders. Instead of relying solely on capital appreciation, you benefit from a steady income stream in the form of dividends. The primary benefit is, of course, the regular income. Companies that consistently pay dividends often have stable cash flows and a history of financial strength. This not only provides you with a source of income but can also act as a cushion during market downturns. A smart move in dividend investing is to reinvest those dividends. By using them to purchase additional shares, you leverage the power of compounding. Over time, this can significantly enhance your overall returns. Look at legendary investors like Benjamin Graham or the Oracle of Omaha, Warren Buffett. Both have emphasized the importance of dividends in a well-rounded investment strategy. Many successful long-term investors have built substantial wealth by focusing on companies with a history of consistent dividend payments. To implement dividend investing, research and choose companies with a strong track record of dividend payments. Look for companies with a history of stable earnings and a commitment to returning value to shareholders through dividends. 5. Research and education. Successful investing begins with knowledge. Researching potential investments thoroughly helps you make informed decisions. Whether you're analyzing individual stocks, mutual funds, or other investment opportunities, understanding the fundamentals is key. The financial markets are dynamic, and staying informed is essential. Follow market news, economic indicators, and industry trends. This knowledge empowers you to make timely adjustments to your portfolio based on changing market conditions. Investing is an ever-evolving landscape, and a commitment to continuous learning is vital. Attend seminars, read books, follow reputable financial websites, and consider seeking advice from experienced investors. The more you know, the better equipped you are to navigate the complexities of the financial markets. Take advantage of technology to streamline your research. Use financial news apps, investment platforms, and data analytics tools to access real-time information. Technology can be a powerful ally in making data-driven investment decisions. Building a solid foundation through research and education not only enhances your decision-making but also instills confidence in your investment strategy. Remember, the more you understand, the more control you have over your financial future. In conclusion, these strategies are the pillars that support a successful investment journey. If you found this video valuable, don't forget to like the video and subscribe for more insights into mastering the world of finance. Stay tuned for our next video, where we'll explore additional strategies to help you achieve your financial goals. Thanks for watching.